Valens Research, Uniform Financial Analytics.
The first thing that's really interesting about Amazon is look at how wrong as-reported returns are for Amazon. On an as-reported return basis, Amazon in 2014 almost was a negative earnings business, right, on an ROA basis. In reality, it was generating a 9% return and growing at 50% a year, right? Also, right now, you'd think Amazon was still a below cost of capital business when it's actually generating a 16% ROA. But the way more powerful thing for us for Amazon is when you look at Amazon on an as-reported PE basis, you see a company with a 66 times PE. A 66 times PE is a really, really high multiple. That's basically saying you think that this company is going to grow at massive levels, 40, 50, 60% earnings growth a year for a sustainable period of time. Those are lofty expectations even for a company that's been as successful at growing as Amazon has been, right? Amazon, if we look historically, the last 3 years, returns were basically level until 2019, and the company doubled its assets in 2017 and grew by 40% in both 2018 and 2019. Meaning, if returns were flat and it grew its assets by 40%, that means it grew earnings by 40%. The market's already pricing in Amazon to have massive growth if you look at the as-reported accounting. But when you look at the uniform accounting, what you see is Amazon's trading at a 32 times multiple. Still not cheap. We are not saying Amazon is a value stock. It is definitely still a growth stock, but at a 32 times multiple, the market's not pricing in nearly as much growth. The market's basically pricing in at a 32 times multiple, this company to have 15% or so earnings growth a year going forward. This company grew earnings by, well, let's see really quickly, on a uniform accounting EPS basis. How much, right? They grew earnings from 2018 to 2019 from a EPS of 50 to an EPS of 58%, right? That's basically 15% growth. So what you're saying is, hey, basically the market is saying you can keep on doing what you did last year, but we don't need you to do anything more. If Amazon, though, executes like they have executed historically, right, they could be massively more growth because we can understand market expectations are not that unreasonable right now. Let's just do a scenario where we think that Amazon's returns, which are forecasted to remain around 15% a year for the next 2 years, let's say they actually remain returns at 15%, and we also see Amazon, which is basically growing at 70%, 60% a year. Let's just say that the growth they had the last 2 years of around 40% continues. If we just plug in that scenario for Amazon, Amazon is not worth, call it $180, $1,800 a share. It's worth $4,700 a share, right? And if you looked at the as-reported metrics, you'd say, Amazon's already priced for all the growth in the world. I don't need to waste my time looking at this company because even if they deliver, it's fairly valued. In reality, we're saying, no, the market's not pricing this company for all the growth that it has because it's only trading at a 30 times multiple. On top of that, you'd think that Amazon was a company plowing money into a low return business. And you'd say, hey, even if they are, they're probably destroying value if they grow a lot in terms of earnings, because that earnings will be below the cost of capital. So we don't even want them to do it anyways. In reality, they're actually investing into a highly profitable business. And that is the exact kind of company that you want to own, especially if it's only trading at a 30 times multiple when they could grow earnings by 30, 40, 50% a year.
Valens Research, the world's leading source for uniform financial analytics.